Okay, we'll start. Right. So there are 25 students. Anyway, we'll start. Meanwhile, please ask the other students to log into the session. Right. Okay, good afternoon again. Um, yes, we were discussing about the risk and return lesson. Right. Which point we stop in the last week? I gave you the homework as I remember. Anyone who completed that? Yes. Anyone who completed that one? No one. I hope this is what we are discussing about. Yes. Just to recall your memory, last week we started with the risk and return. Risk and return, and then we identified what is mean by a investment, the basic concepts of the basic components of the investment, and then the relationship between risk and return. So then we identified what is mean by a return, how to calculate the return of a single security or as the stock specially. Stock return is comprised with the dividend and the capital gain. So where we identified D as the capital, the dividend, and then the P1 difference between PT and the PT minus 1, that is the capital gain. To convert that one for a yield, we are dividing it by the acquired price PT. Right. So this is the basis for the return calculation, and then we identify the holding period return. The investment, if we have invested in a whatever the investment, how you can calculate holding period return, and then how you can convert that holding period return into the yield. Plus, we identify the annual holding period return as well as the annual holding period yield. And then we did the example number 1. And then average rate of return, we have calculated R bar, total of the R or else total returns collected and then divided by the until the maturity period or else until the end period divided by N, which gives us the average return for a average rate of return. And then we go to the example number 3 and we calculated the arithmetic average return. Moving forward, that with that one, we identified the risk as well as the how to measure the risk, right? Basically, we are discussing risk with the standard deviation and calculation of the variation and converting that variation with the standard deviation, and then we have to identify the coefficient of variation when we are comparing the risk and return together. Basis for the calculation of risk, that is the standard deviation as well as the variance, right? So based on the historical data, if we are calculating the variance, we have to take the difference between the actual returns versus the average return, or is the actual return versus the R bar. So sometime if we are getting minus value, so therefore we are multiplying it by 2. That means we are taking the square root. We are taking the to the power, and then we take the total of these variances value, and then dividing it by n minus 1 value. So then we can have the variance of that particular stock. After having the variance, what you can do is taking the square root of that variance gives us the standard deviation. That means real reflection of the risk of that individual security, or else it might be share. So this is what we have learned in the last week, and then we discussed the example number 5 also. Did we discuss the question number 5? Girls, boys, did we discuss the question number 5? Yes or no?
That was the homework, miss.
Yes, that was the homework. Very good. Anyone who completed the homework then? Okay, raise your hand. Anyone who completed the question number 5? So you can identify there is an icon called race. See here in the Teams login, you can identify there is an icon called a race. So then if you have done that one, quickly raise your hands. No one completed. No one is answering for the question. That means it implies that no one didn't complete this one. Okay, now this is your task, right? Complete this one. So this is totally the calculation lesson, right? We can't do it without any calculations by looking at the question or else by hearing what I'm saying to you. You can't complete the risk and return the lesson. So therefore, you have to practically engage with this one. Last week also, I told you that how you can take the variances. Right, again, I'm explaining that. We'll go to the question. You have been given the stocks S and C annual rate of return during 2020 to 2024. Right, regarding the S, you are starting with 10.5 and then ended up with the 10 in the 2024. Regarding C, you started with the 8 and then stopped with at the 6. So these are the annual return, historical return. So we are in 2025. These details are for the 2020 and 2024, which implies the 1 years back the annual rate of return from the 2020. Right. So what you need to calculate is the arithmetic average return, variance, standard deviation, and the coefficient of variation. Right. Last week also I explained this one. So we have to take first the variance before moving to the standard deviation. The first task is calculation of a variance. How we can identify the variance? We have to identify the difference between 10.5 and the calculated average value, or else R bar. Have you calculated the R bar? As I remember, we have calculated R bar. What is our R bar? Yes, what is our R bar? R bar for S.
0.9.
Very good. 0.9.
9.
Good. That means 10.5 minus 0. Or else 9. 0.99 there. 0.92. What's the value, real value? Yes. Is that 0.99 or else what's the real value?
10.9, miss.
10.9. Okay. 1, 2, 3, 4, 5. 5. 5. It's 10.9. For the C, it is 9.2. Am I correct? Am I correct?
Yeah.
Yes. For the S, the average value of R or else R bar, that is 10.9. But for the C, that is 8 minus 9.2. 9.2. Take the values quickly. I will give 10 minutes and I will ask from one by one from you. Fill this table quickly. I hope you all can see this table. Take the difference between 10 and 10.5 and 10.9, that which is an average value for regarding the S, and take the differences, all the differences from the C. That means difference indicate the real value when the bar R bar of C. And then take the square root of these values. Quickly fill this one. And quickly fill this one. I will ask one by one. We have the list. Akif, Abdullah, Aryaratna, Bandara, Chamudini. We have a lot of students here, no? Right. We'll ask from them one by one. And then quickly before moving to that part, please fill this table. Without doing it from your end, we can't complete the lesson. So therefore, that is why I am asking from you, you do it first. Take the differences.
तसं मुंबई कधी गेला සතියේ එන්නේ එන්න බැලුම්
Okay, so then we'll start. Here it should be 12 minus 10.9. 13 minus 10.9. Then 9 minus 10.9. 10 minus 10.9. Next one for the C 2021. Again 12 minus 9.2. 7 minus 9.2. 13 minus 9.2. 6 minus 9.2. Okay. Now tell me the values. For 2021, the difference between the actual and the average return, how much is it? You all need to calculate and tell me how much is the difference. No one is going to answer for me. Yes, what's the difference there?
Minus 0.4.
Good. Minus 0.4. Here.
1.1.
1.1. Next line.
2.1.
2.9. 2.1, eh? 2.1. 2023.
Minus 1.9.
Minus 1.1.
Right.
Last year. Again, value is how much? 0. Minus 0.9, eh?
Teacher, 2023 minus 1.9.
1.9. Okay, good. Thank you. So then we'll move to the next one, next year. Next year, for the next, the security called C. The difference 8 minus 9.2. It is minus 1.2. For 2020, 1. The difference
2.1.
2.8. 2.8. 2023
Minus 2.2.
minus 2.2.
2.2.
For 2023, it should be
3.8.
3.8. Last year, 2024, the difference
Minus 3.2.
minus 3.2. Right. Okay, hope you all got the same answers. Others? Right. So then we can square root. Right. Okay, we have the 0 for the first one. For the first one, that is minus 0.4. Then squared. What's the value? Minus
0.16.
0.16.
16.
0.16. Good. For the second one, that's 1.1 squared. What's the value?
1.21.
1.21. Third one, 2.1 squared.
4.41.
4.41. 2023 now minus 1.9 squared.
3.61.
3.61. Last year minus 0.9 squared.
0.81.
0.81. For the security C, we completed this S, then we'll move to the security C. The first one, it is 1.2 squared.
1.44.
1.42.
44.
Only 1.4.
4.4. Another 4.
Good. Second one, 2.8. 2.8 squared.
7.84.
7.84. 2022 to minus 2.2. Minus 2.2 squared.
4.84.
4.84.
84.
Right. The next one, 3.8 squared.
13.032.
0.33.
3.32.
Right. The last year, that is minus 3.2 squared.
10.24.
10.24. Right. Okay. Now we have taken the differences and the squared value of these differences. Okay. The next task, how we can calculate the variance? Take the total of it. Summation. Sigma. Now take the total of these squared values. That means these columns. What's the total of it? Take the total value here and tell me.
Madam,
Yes.
3.88 square root answer is 14.44. No,
Is that 14.4?
44.
Yes, 14.44.
Okay. Good. Very good. Huh? I'm really happy for you. You are actively engaged with the activities. I'm really proud for you. Do it. We'll do it simply. So this is an online session. No, otherwise, if it is a classroom session, I will go through that one in a other manner. Anyway, we'll do it one by one slowly. So then you all can understand that one. Otherwise, via the online lectures, if I am doing the calculation myself, so then you can't understand what's going on. Okay. Take the total. Yes, how much is the total?
10.2.
10.2. Here, for the C,
38.8.
38.8. Right. Okay, now we have taken the variance. Variance done. Right. We have taken the total, not the entire variance. Huh? Total taken. So then we'll have total. Right. So how we can calculate the variance? Total should be divided by n minus 1. Right. Now we can calculate the variance. Okay. Calculate the variance now. So I will duplicate. Total is 10.2 and 38.8. So then identification of variance. Variance equal 10.2 divided by how many years do we have? We have 4 years or 5 years. We have 5 years. 2020, 1, 2, 3, 4. That means 5 years. So therefore, we have to divide this 10.5, 10.2 by 4. That means 5 minus 1. Next one, 38.8 minus 5 minus divided by 5 minus 1. Now you can calculate the variance. How much is the variance now? 10.2 minus, divided by 4. How much is it? 2.2.55.
2.55.
The next one, 38.3 divided by 4. It is 9.38.
10.8.
38.8, ne? Okay. 38.8. Take the 38.8 divided by 4. How much is it?
7.
9.7, ne? 9.7. That. Now the variance has been calculated. That is 2.55 and 9.7. Now you can calculate the next concept. Now still we didn't calculate the risk of that individual security. What we have calculated is variance. The risk measurement is the standard deviation. So therefore, based on the variance, you need to calculate the standard deviation. Standard deviation equals the square root of the variance. Now you can take the square root of the variance. Take it. Square root of the variance. Variance value has been calculated. Now you can take the square root of variance. Square root of 2.55 and the other one square root of 9.7. Okay. What are the standard deviations? For the S. What's the standard deviation?
1.596.
1.596.
96.
Right. The other asset, C. Square root of 9.7.
3.11.
3.11. Okay, now we have calculated the standard deviation which notify us the risk of this individual security, or else risk of the S and then risk of C, security S and C. Now make a table. By combining your return and the risk answers, make a small table. Take 2 rows for the risk and then return, and then take 2 columns for the 2 assets. Summarize your findings, risk and returns of these 2 assets. 1.596. For C, that is 3.1. Returns 10.9 and 9.2. Okay. So this is what we have summarized. This is what we have summarized. What's the value? Risk 1.596 for the S and then the 3.1 for the C. Return 10.9 for the S and then 9.2 for the C. Right. Based on this conclusion, so this is what we have concluded by our calculations. Right? Based on this conclusion, can you recommend which asset or else which stock do we need to purchase? Can anyone comment? Yes. As a rational investor, what do you need to select out of these two stocks by looking at this information? Any answer? If you are a rational investor, which investment, which stock you are going to select for your investment? Whether that is S or C.
Yes.
S. Why? What's the reason for selecting S? Yes, why we are selecting S? Any special reason?
Return is high.
Very good. Return is high. Good answer. Is that all?
Risk is less.
Very good. Other one, risk is less, right? As a rational investor, when we are discussing this lesson, I've explained that one in first day also. When as a rational investor, when you are taking the investment decision, always what you need to consider is the risk and return. Risk versus needed to be considered. In here, we have if we are comparing the S and C, you can obtain that regarding the risk. S is having a very less risk with compared to C. Meanwhile, return for the S also high with compared to C. Now, if you are comparing risk and return together, so you can identify that S is the most selectable or else most suitable investment for your most suitable security for your investment, since the return is high and then the risk is low. But in each scenario, you can't identify these set of things. If you are comparing your investment with the other stock, you can't always obtain the same set of formats here. Sometimes you might get the high risk with the high return, right? Sometimes you may get high risk, low risk, low return, and likewise, so there may be some confusion scenarios. So therefore, as a rational investor, moving forward, we are taking our investment decision by considering this risk versus return technically rather than looking at just. With that, we are starting the following or else calculation of which one? Calculation of coefficient of variation. We need to calculate coefficient of variation which compares risk versus return of that particular investment or else the security. In here, if I technically explain this concepts with the given value, given the empathical, the investment in the stock, that is the I, right? If you are identifying the coefficient of variation of I share, you have to divide the expected or you have to divide the return. Sorry, you have to divide the calculated risk, that means sigma, the standard deviation here, standard deviation of the share I, by the risk, the return of the I, that means R bar. In our example, so we also have two values for the two securities where we have the chance to calculate the coefficient of variation, and by looking at this coefficient of variation, next we'll identify whether we are going with this investment or else not, rather than looking at just the risk and return at a glance. Right, okay. Now calculate the coefficient of variation. Quickly do it. Here we'll also calculate coefficient of coefficient of variation. Coefficient of variation. How you can calculate the coefficient of variation? Divide the risk by return. Risk or the standard deviation. Measure risk measured via the standard deviation of which asset S should be divided by return. Return of return of the S, or else technically we are taking which one? R bar. R bar of S. Calculate the coefficient of variation. Here risk is 1.596 divided by 10.9. Quickly calculate the value for the value means coefficient of variation for the S and C. Here it can be identified as 3.11 divided by 92. Tell me the values. Yes. What are the values? Yes, what are the values?
0.4, 0.146.
0.146. The other one?
0.338.
Okay. Right. So now tell me what this denotes. We divide the risk by return. Now we have taken these answers, right? So what these two answers denotes? For a one return, how much of risk? How much of risk that the investor is going to bear from this asset or else from this share? Regarding the security, yes. The investor, for a one return, the investor is going to bear 0.146. The security C, for a one return of a investment, right? For a one return of an investment from this security C, the investor need to bear 0.338 risk. Again, what this coefficient of variation denotes? For a one return, how much of risk that the investor is going to bear for that specific the share. As per our answers, for the S, for a one return, the investor is going to bear 0.146 risk. But for an investment C, in here also, we can identify for a one return, investor need to bear 0.338 risk. By looking at these values, which investment is a good one to invest? Any comments? Based on the coefficient of variation, do we need to select S or C? We have to select S or C. Which investment do we need to select? We need to definitely select S. Why? What's the reason? For a one return, they are going to have only 1.46 risk. Whereas C, if we have invested in C, for a one return that you are going to have in future, you need to bear 0.338. So therefore, by looking at this coefficient of variation rather than just looking at the given risk and return values, what you are technically doing is you are calculating for a one return, how much of risk you are going to bear. So then you have to select which, according to that facts, you have to select the stock S, not the C. Right. Okay. Is that clear? Okay, hope it is clear to you all. Right. Tell me, if the coefficient of variation is high, how about the volatility of this data set or as volatility of the past share prices? What's your idea? If the coefficient of variation high, how you can predict about the past returns, or else the volatility of past return, is that high or low? Yes, any answers? Yes. What about the volatility of data set? Any answers? Volatility means the variances of the returns. High or low? Again, question is if the coefficient of variation is high. If the coefficient of variation high, how about the volatility of the returns? Coefficient of variation high. So then the volatility of the variances, volatility of the data set or the single security return is high. Variances also high. Volatility also high. So then how about the consistency of the data set? How about the consistency of the data set? Yes? Any answers? Consistency of the data set? Yes? I need the answers. Consistency of the data set? Volatility high, variances high, but so then what happened to the consistency? Consistency is low, right? Other way around, if the coefficient of variation is low, it denotes the volatility of the data set is low. Volatility of the data set is low, or else the variances of the data set is low. And it gives us a very consistent data set. So therefore, again, the share prices, the differences between share prices and then the average values are not that much high. You can confirm that. We'll go to the table here. The fact that we have arisen from this coefficient of variation can be confirmed by looking at this table. Right? Regarding the first one, regarding the S, right? The coefficient of variation is low. Meanwhile, you can obtain that difference between the actual and the S. The S bar value is slightly lower than the C. Whereas C, it is having a high coefficient of variation, which leads to it definitely have a high variance, right? High variance with the actual values and then the average value. Look, you can confirm that by looking at the data set. From the first, with compared to the S, what happened to the C value? Return value or as differences between C, those are very high. But S, so those are low. Because of that high volatility in the C, definitely it gives us a high coefficient of variation. Whereas we can conclude that this data set is not that much consistent with compared to the S. But for the S, the data set is consistent because why? Having a difference between the actual and the expected values are very low. So therefore, we can come to the conclusion that if the coefficient of variation is high, if you want, you can write it down. If the coefficient of variation high, the volatility of the data set or else the variances of the data set is high, but consistency low. Data set consistency low. The other way around, if the coefficient of variation is low, it indicates the variances or else the volatility of the data set of the given period is low. Meanwhile, the consistency of data set is high. So these are the some set of the basic concepts regarding risk and return. We can go to the other concepts. If you are clear on these concepts, we can go to the next concept, calculation of risk and return with the expected returns, expected economic conditions. Yes. Do you have any question on this area? The basic concepts, standard deviation, variances, and then the other one, coefficient of variation. Do you have any question on this area? Silence denotes you don't have any question on this area. So therefore, we can go to the next concept. Right. Now, can you all see the screen, the expected return?
Yes, madam.
Okay. Right. So what we are going previously, what we have done, so you can recall you can recall the question number 5. That is in there we have given the risk for the 2020 to 2024. That means the past data. But always as investors, we can't predict on the past data. You have to analyze the future data as well. Future data means in future when we are considering on the return of the stock, we can in the future in the economy. So we may have some set of the different conditions in the economy. We can't expect, for example, so within 10 days, we can't expect the same, the economic conditions might be there. It might be changed. Again, for a next 6 months, we can't predict the same condition at present. What happened? There might be different economic conditions. If there might be a different economic conditions, what happened to the return of this stock? Definitely, those returns might be changed. Now, what we are going to analyze is if you are an investor based on the expected return in future, how you can identify that average risk and return of this investment or as the security by taking the possible future economic conditions, because why? We might have the future several economic conditions. Now the calculation considering the future economic conditions and the future expected return when we are calculating the risk and the return of that specific investment or is the return, the security or a share. Right. In determining the expected return of a stock, probability of occurring the future returns are the forecasted in accordance with the possible future economic condition. Now the next thing, right? So if we are having if we have the possible future economic conditions, we have to predict that future economic condition. An example, I will take the 3 economic conditions, right? Within next month period, there might be 3 economic conditions. What those are? Good, normal, bad. Now thinking within the next month, I'm just considering within next month. So there might be 3 economic conditions. The first one, it might be good, it might be normal as same as present, and it might be bad or very bad. 3 economic conditions. So when we are identifying these 3 economic conditions, all the 3 economic conditions are not happening at the same time. There are possibilities. We'll just assume based on the present information, the economic condition good, occurrence of that economic condition good is 0.5. That means 50% chance is there to occur a good economic condition. The other one, 25% of chance might be there to occur a normal economic condition, future economic condition. The other 25% chance is there to identify a bad economic condition. So therefore, you have to identify the probabilities of occurring these future economic conditions. By considering these the future economic conditions with the probability of occurrence of that future economic condition, now you have to consider what might be the return and risk of that specific investment, right? So if we are identifying the return or as expected return under the different economic conditions, you have to apply now. The new thing is here. What is that? So this is the probability of the X variable or as X share, right? Okay. Again, what happens if we are calculating the risk based on the expected results under the different economic conditions? Your standard deviation, variance, and then the coefficient of variation plus covariance formulas have some slight changes as we did in the previous question. There are some differences. What we need to consider is probability, right? But most of the features are similar, but there are some slight changes in calculation, right? Okay. Now we'll identify. Example number 6. Read the question. Consider the following information relating to the forecasted return for the stocks. What are the stocks? We have J and K. We have 2 stocks. Under 4 possible economic condition. That should be corrected. The 4 possible economic condition. Right. In future, there might be a economic condition 1. That's a condition. In our example, I have taken it as a good. Probability is 0.1. Occurrence of that one economy, that is 0.10. 10ක් වෙන්න පුළුවන් මේක ඇති වෙන්න තියෙන chance එක. Second one, the second economic condition, the probability of the occurrence of that second economic condition is 0.2, 20%. Third one is the occurrence of the third economic condition, that is 50%. Based on the given information, we are pretty sure that 50% chance is there to occur the economic condition 3. The last one, again, economic condition 4, the occurrence of that economic condition probability is 20% or 0.2 or else 20%. Right. Under this, each and every economic status, you have given the return of the 2 stocks. I will just explain the first one. Right. If the probability, if it is occurred the the economy 1, right, economy type 1, under the probability condition 10%, you might have a 8.5 minus return from J. The next one, if you have again under the same economic condition with the probability of 10%, you have to identify the return for K is plus 8.5. Under the second one, if it is occurred the second economic condition, what are your return for J? That is 7.2, and then the other one minus 5.4. Under the third economic condition, if that occurs, again, if that occurs under the 50% probability, from the J, we might have 6.5 as well as from the K, we might have 4.3 return. Right? So these are the returns under the possible economic condition, 4 possible economic conditions. Right. What you need to calculate based on the given information, expected return, and then the variance, standard deviation, coefficient of variation. So these are the some of the calculation that we did in the question number 5 also. And with that, we have a new thing, that is the covariance between the returns of the 2 stocks. Covariance is something new to us. Okay. Right. Quickly format this same table to your handwritten books, right, with the 6 columns. Now take the 6 columns. Okay. Hope you have copied the table. Right. So in here, how we can calculate the first task when we are identifying the risk or is the standard deviation calculation, variance calculation, what you need to do first, you have to identify the risk. In the first question also, we identify the first risk. If we have given this kind of a scenario, how you can identify the risk of that return? Initially, you had to identify the return. Sorry, we had to identify the return. So then how you can identify the return? These are the future returns. How we can identify the return? Now, can we take the average values or else R bar? No, we can't. What you need to do is you have to identify the future returns with the probability, with identifying the probability levels. It's like this. Right. The first one, if the economic condition 1 happens, we can identify 8.5 minus 8.5 return. But the probability level of occurrence of that 8.5 is 0.1. So then second economic condition, right? Under the second economic condition, we might have the 7.2 return, but the economic condition probability is 0.2. Third one. Third one. I hope it's clear. Third one. Return is 6.5, but the probability of occurrence of that 6.5 is 0.5. Plus. Under the fourth economic condition, we are going to have 4.2 return, but the probability level is 20% or 0.2. Now you can get the average values for the expected returns. What are the values? Yes, anyone who calculated? Before moving to the various calculation, first we need to identify the return. Now these are not the historical returns. What these are the expected returns. So therefore, how we can make it as average value by multiplying each probability levels with the expected returns under the economic conditions. What's the value there?
4.68.
Very good, 4.68. Do the same one for the K also. For the K. For the K. 8.5. We are getting 8.5 multiplied by economic condition occurrence is 0.1 plus. The next one, we are having minus 5.4 under the second economic condition occurrence is 0.2 or else 20% plus. Third one, that is 4.3 the return is 4.3 under the economic condition 3, but the occurrence of that economic condition that is 0.5. Right. The last one, Under the economic condition 4, we are going to have 7.5 return, but the occurrence is 0.2. Yes, what's the value there? 3.42. 3.42. Is 3.42. First one 6.8 and then the other one 3.42. Okay. Now we have taken the average expected returns. The next step, the return now okay. These are the expected return, right? You can name this as expected return. Expected return of J equals. The other one, expected return of K equals 3.42. Okay. Hope you did it. Right. Now what you need to take? The difference between what? The difference between the actual value, the expected returns and then the average returns, right? Okay, we'll take it. We have the average return for the two assets, 4.68 and 3.48. But we have given the future returns under different economic condition. Now you need to compare these things, right? Under the economic condition 1, right? For the J, we are first taking the J, asset J, right? We expect 8 minus 8.5 for the J under the first economic condition. But the average is 6.48. 4.68. The next one. Under the economic condition 2, we expect 7.2 for the J. But the average value that is 4.68. Under the economic condition 3, expected one 6.5 and but the average expected value that is 4.68. The last one we expected 4.2 but the average expectation that is 4.68. Right. Tell me the first one value.
Minus 13.18.
Minus 13.18. Okay. Under the other one as well. Okay, sorry, I had a connection issue. Okay, is this visible to you all now?
Yes, miss.
All right, thank you. Right, we'll go to the next one. Under the economic condition 2, what's the difference? 7.2 minus 6.48. 4.68.
2.52.
2.52. Thank you. Third one,
1.82.
1.82. Last one,
0.4.
0.48. Right.
Minus 0.48,
Minus
madam.
Minus 0.48. Okay. Next one. For the K. Okay. What we need to do is we need to identify the difference between the expected return and the actual, the given return under the different economic condition. Different given economic condition under the given economic condition, return is 8.5 now, but averagely we expect from K, that is 3.48, 3.42. Right. What's the difference?
5.08.
5.08. Right. Next one, under the second economic condition, the expectation is to have a minus 5.4, but the average value is 3.42. We are differentiation. We are going to have the differentiation in between these two values. What's the difference?
Minus 8.82.
Minus
8.82.
minus 8.42.
82.
82.
82. Third one, 4.3 is the given economic condition return, but the expectation is to have a minimally 3.42. What's the difference? 0.88.
88.
Right. The last one, economic condition 4, for the share K, we are expecting to have a 7.5, but the average value it is 3.4. The difference 3.4.08.
4.08.
Right. Okay, so these are the differences. Now we are going to have the square root. Okay, we'll now write it down in the technical terms, right? Okay. Right. We might have different economic. This is the stock J under the different economic condition 1. Right. We just write it down J. Right. Otherwise, you have to write down one by one. So therefore, write it down the RJ and then expected return for the J. Right. And then no need to do the square root. No need to do that. No need to take the root value here. We'll take that one in the next column. Since it is a first question, right? So if it is clear to you, you go ahead with the the part. No issues. But since it is a first question, you will do it one by one. Otherwise, it might be a complex one. For the second one, right, so we have the stock K and then expected return for the K. Now you can do the square root. As we did in the first question number 5, square root not square root. You need to take the squared value here to the next column. Right. Take the squared values. First difference is 13.8. 13.18 squared equals. Second difference 2.52 squared. Squared. Third one, the difference is 1.82 squared. The last one minus 0.48 squared. Still, we didn't apply the probability, but we have to apply the probability also. Okay.
First one is, madam, minus 13.818.
Okay. Thank you. Right. Now take the values. Now in the technical terms, you have to mention here as a squared value. I'm struggling to insert these icons anyway too. It should be squared. Okay. For the first one, squared value minus 13.18 squared. What's the value there? 100.
73.7.
173.3. Okay. For the second one, 2.52 squared.
6.35.
6.35. Minus, 1.82 squared.
3.312.
3.312. Minus 0.48 squared.
0.23.
Okay, good. Thank you. We'll go to the next one. Right? The share K. You have to identify the difference and then square it. First one minus 5.08 squared equals. Second one minus 8.82 squared. Third one difference 0.88 squared. Last one 4.08 squared. Since it is the first question, if you can write down these one by one steps, that's better. Okay. For the first one. What's the value? Minus 5.08 squared.
25.80, madam.
25.80.
80.
Second one.
77.79.
77.79. Third one.
0.77.
Last one.
16.64.
16.64. Right. Now, still we didn't apply the probability levels. We just have taken the differences between the expected value and the average expectation. Now the next column is to apply the probability levels for this answer. Now we'll identify technically probability of which one for the J. We need to apply the probability of that occurrence of that economic condition for the difference that we have calculated in the column number 1, 2, 3, 4, 5, 6, 7. 7 for the K, 7 for the J, and then the next one, K, 8 for the next column. Right. Okay. Probability, applying the probability for what? For the difference, scarred difference. Not just difference, scarred difference. Calculated in the column 7. Right. This is the probability. Next one, applying the probability. Probability for the difference between scared difference between the R and then the expected average return of R, not RK. Okay. We have the scared difference. Scared difference is 173.3. Applying the probability level by multiplying it 0.1. 0.1. Second difference, scared difference, that is 6.35. Applying the economic condition occurrence probability, that is 0.2. Third one, probability of occurrence of that, the economic condition, that is 0.5, but the scared difference is 3.312. 0.5. The last one, the scared difference is 0.23, but the probability of occurrence of that economic condition, that is 0.2. Right. Next one, for the K. For the K, scar difference is 25.80. But the probability of occurrence that economic condition 0.1. These are the values. Oh. Yes, anyone want to call me? No. Any questions?
No, ma'am.
Okay. Second one, scar difference is the 6.35. Multiplied by the probability of occurrence at the economic condition, that is 0.2. Third economic condition, scar difference is 0.77. Multiplied by the probability of occurrence that the difference is 0.5. That is what we are doing here. We identify the difference of this expectation as well as the given value, that is the 16.64. But that occurrence is 0.2. The chance is 0.2. Right. Here, what's the value? First one. For the J, first probability level application.
17.33.
17.33. Second one.
1.27.
1.27. Next one.
1.65.
1.65.
Yes,
Fourth
madam.
economic condition.
0.046.
Good. Will more than the asset K. Now tell me the application of the probability levels. First one. 2.58.
2.58.
Second one. 3.6. 3.1. 3.
Ek 77.79 into
Sorry, Puta, I didn't get you.
square करने 77.79 into. Yeah. मामा डालती
6.35 multiplied by the remainder. Good. Thank you very much. So it should be 77.79 multiplied by 2. Ne? Okay, good. What's the answer then?
15.55.
15.58.
5. Good. Next one. 0.38.
8.
Okay, 38. The last one.
3.328.
Now, Okay, we have taken the differences, what we did. So we identified first the expected return, and then we took the difference between the expected return, average return, and the given returns, and then we scarred it. Once after the scarred, we identify the probability level of occurrence of that economic condition to the identified scarred values. That is what we did up to now. Okay. Now we'll already already identified the variances figures, right? Now we'll go to the gain formula. What it identified the total of these values. So therefore, take the total of these columns. The last two columns, take the totals. And tell me the totals. It is 17.33 plus 1.2 plus 1.65 plus 0.046.
$20.296.
Sorry, Buddha.
20.296.
20.496. Okay. Next one.
21.82.
20.
1.82.
Okay, good. So these are what? These are the variances. Variances. Right. Quickly now you can calculate the standard deviation also. Right? Standard deviation. How you can calculate the standard deviation? No need to consider the other things, but you need to just do it. We take the square root of the variances. Take the square root of variances and calculate the standard deviation. These are very simple things. If you are going to it in the first time, that might be little bit, you feel that might be difficult, but these are very simple calculations. Okay. Standard deviation SD equals square root of the 20.496. Okay, tell me this standard deviation for J. 4.505.
505.
For K, 4
Again,
point, 3 point, ne? 3 point. The, no, again 4, ne?
4.67.
4.67.
67.
Right. Okay. Right. So this is what? This is the risk of the or a standard via the standard deviation what we calculate, that's the risk. Technically, what we are taking standard deviation calculate by the applications we are come up to the risk calculation. Right. So then risk is risk of the asset J and asset K. J is 4.505 and then the K is 4.67. Right. Okay. Again, what you can do is you can calculate the coefficient of variation. Now make the table. Next task, right? Make the table as we did in the previous question number 5 also. Make the table J and K and risk and return. Quickly do it. Meanwhile, you can have a 10 minutes break and come. Do it and then have a break and come for a 5:20, 5:20, 5:22.
Teacher, break start from now.
Sorry?
Break start from now.
Yes, yes.
Okay.
Meanwhile, you can do the calculations also.
Madam,
Yes?
Madam, probability column variance answer is 20.296.
This one.
Yes, madam.
Yes,
20.296.
madam.
So then what about the answer? It's going to be changed, no?
No, it's
No,
same
answer is
answer.
same.
Answer is same. Okay, but Okay, we'll start again. We have two stock J and K. And so then we can identify the risk and so we can technically name it as a expected risk. Expected risk and then the expected return. Expected risk, how much is it? 4.505. For the K, it is 4.67. Expected return, we calculated the expected return also, that is 4.69, 4.68 and the 3.42. 4.68 and then the other one 3.42. That. By looking at this information, what you can conclude? Which asset do we need to buy? At a glance, you can identify that you can buy the which asset? Yes,
J, madam.
J.
J.
Why? What is the reason?
The risk, expected return is
High.
higher than the risk.
That might be a one reason. Expected return. But when we are technical taking that one, what do you need to calculate? Last we calculated the coefficient of variation. Then we can identify technically what is the asset or else what is the share do we need to buy. Right. Okay, so then we'll identify the coefficient of variation. We'll calculate it. Coefficient of variation. How we can calculate the coefficient of variation? Risk divided by return. In this one, risk of J should be divided by return of J. In the next case, risk of K needed to be divided by return of K. Risk of J that is 4.505. Return is 4.68. For the K, risk is 4.67 divided by return, that is 3.42. Calculate and tell me the answer.
Zero point 962.
For K,
1.365.
now you can take the rational decision. Based on the coefficient of variation, what you are going to identify, or else which asset you select for investment. Is that J or is that K? By looking at the coefficient of variation as a rational investor, what's the investment that you are going to select for your investment? Are you going to invest in J or else are you going to invest in K?
J.
J. Why? What's the reason? Why we are selecting J? Any others? Others? Why should we select J? The answer is so correct. We need to select J. Why? What's the reason?
For a one return, they have to bear 0.962 risk.
With compared to the J. With compare, that is how we are writing the answers. Very good answer. Thank you very much. So how we can write that one with compared to the J, with compared to the K. The security J or a share J is receiving only 0.962 for a 0.962 risk for a one return. Again, with compared to the J, with compared to the K, the asset J or else the share security J is receiving 0.962 risk for a one return. Meanwhile, what happened to the K? For a one return, they have to bear 1.365 risk. So then whichever the lowest one needed to be out of this coefficient of variation needed to be selected for the investment. Accordingly, we are selecting what? We are selecting the security J to invest. Right. Okay, I hope now the basis is clear. We had what from where we need to start. We have to start with the calculation of return. Sometime it might be calculation of return based on the historical data, and then sometime you can calculate the return based on the expected data. Normally we are going with the expected data calculation. Anyway, once after you calculated the returns, then your task should be identifying the differences between average returns as well as the given returns. To mitigate the negative and the plus sinus value, so what you are doing is you are taking the root. So then what you are doing is we are taking the total, then variance, and then go to the standard deviation. That's it. After calculation of the standard deviation with the return, now you need, when you are taking the buying decision, you need to compare these two by calculating the coefficient of variation. Which one is lowest needed to be selected for your investment? Since it is give the lowest risk for a one return. That's what we have up to now identified. Okay. Right. I hope the basis is clear. That's the end of the right. We have another one. We have to calculate the covariance also. Right. What do you mean by the covariance? Yes. Oh, what order you have calculated the covariance in your mathematics subject? For what we are taking the covariance? Any ideas? Covariance. Yes, covariance. Okay, covariance technically identifies the directional relationship between two returns of two assets. Again, covariance identify the directional relationship. Directional means whether it is a positive or negative relationship between two returns of two assets, right? Two returns of two assets, covariance, right? Sometimes it identify definitely the directional relationship. It might be positive covariance, sometimes it might be the negative covariance, right? Positive covariance means the two returns of two assets move together. If the return increases of the one asset, the way around, the other asset return also increasing. Negative covariance implies there is an inverse relationship between two assets returns. That is, if the one asset's return increasing, what happened to the other asset return? It's going down, it's decreasing. That means inverse relationship. What sort of relationship between these two assets return is determined by the covariance concept. Right. In finance, we are taking, you might have the covariance in your mathematics subject, as I said previously. But in the finance, for most probably, what we are taking the concept of variance, for what we are taking the concept of this variance to identify the directional relationship between two stocks to return. That means asset valuation, single security plus portfolio valuation, we are taking the concept of this variance, right? Okay, how we can calculate this, the covariance? You need to identify the probability of occurrence of these economic conditions with the difference between the expected return and then the actual return, the expected return and the average expected return that we have given us, right? Okay, now take the another table with 3 columns. 1, 2, 3. Yes, 3 columns. we need to first identify the probability levels. In our scenario, we have 4 economic conditions. With that, we have four the probability levels. What those 4 probability levels? 0.1, 0.2, 0.5, and then the last one 0.2. Right. So these are the probability levels. When identifying the covariance, you have to consider the covariance means as name implies, it's the identification of the directional relationship between two stocks, two returns. Right? Now we have to consider now the two stocks returns. Right? How we can take that one, the variances. Right. Two stocks, we have two J and K, and then returns. Now we have the return changes. 13.18. That before moving to the scar values, we need to take the differences, initial differences. Why? If we take the scar, what happened to the values? The plus and minus values are the plus and minus values are the what happened to it? How I can explain that one? Yes, to mitigate the negative signs as well as a positive sign, we are going to have the scared value, right? If we take the scared value, it already removed the negative and plus signs. The real implication, the values, the real differences between these the two values, that means expected return and the given returns. So therefore, we are not taking the scared values. Before taking the scared value, you need to take the real differences in between real differences in the expected return and then the given return. So therefore, we have to take 13.18. And then what we are doing is we are considering the two assets, two stocks returns. So therefore, you need to consider the other asset as well. So this is the difference between J. And then you need to consider the difference between K also. What's the difference there? The difference, that is 5.08. 5.08. Second one. Under the economic condition 2, we identify the difference between expected return of J and then the given return of the J, that is 2.52. 2.52. And then the difference between expected return and then the given return of K is, that is, how much is it? Minus 8.82. Right. Under the third economic condition, the difference between expected return and then the given return, 1.82. For the K, 0.88. Under the fourth economic condition, the difference between the expected return and the given return, that is minus 0.48. And then for the K, the difference is 4.08. Right. Are you clear on this? Okay. Right. I hope it's clear up to now. I made the terms here also. If you want, you can write it down. When identifying this covariance, you have to multiply these three items and take the values. Right. First one. The difference regarding J, that is 13.18, multiplied by the difference for the K, that is 5.08, with the probability 0.1, equals. The second one, under the economic condition 2, we have two assets. First give us the difference 2.52. The second gives us the difference minus 8.82, equals. Third one, under the third economic condition, the probability of occurrence of that third economic condition, that is 0.5. Under that economic condition, we have two different the returns for the J and K, 1.82 multiplied by the other one 0.88, equals. Last economic condition, we have the last economic condition, the occurrence is 0.2, and then the difference between the expected and the actual return, the given return regarding J, that is minus 0.48, multiplied by the difference between K, that is 4.08, equals. Right. Okay. Tell me the values. For the first one, what's the value?
6.695.
Okay. $6.695. Second one.
Minus 4.445.
Good. Third one. Plus.
0.8.
Last one.
Minus 0.391.
Good. For the first one, that is minus, no? Make a minus name, Buddha.
Oh.
Right. What's the answer? Total. Take the total now. Covariance equals minus 10 point. What's the answer?
Minus 1.84.
Minus
1.846. 846.
Any other answers?
Minus 1.059.
Any other answers? You have to take the total of these values. Isn't that minus 10.71?
3.436.
Sorry?
3.436.
Any other answers?
Minus 10.71, miss.
Minus 10.71. Yes. What you need to add is minus 6.695 and then minus 4.45 and then the plus 0.8 and then the last one minus 0.391. Okay. Out of these four answers, what is the correct answer now you received?
Fourth one.
Fourth one, no? That should be the minus 10.71.
10.731.
Okay, 7.3 slash 7.73. Okay. The slight differences, no? Any other answers? Okay. Hope you all got the same answer. Minus 10.71 or 73. Any deviations? Any questions? Okay. Right. Okay, so then we'll go to the next part. Okay, what we have discussed is based on the expected return, based on the expected given economic conditions, or else based on the historical data, how you can calculate the risk and return. So this is how we can calculate the risk and return of a single securities. Right? We had used this S and C plus the J and K. Those are what single securities. Right? Next task is by combining these, if we are having the, when we, in here what we discuss, we have funds. Right? We have funds, so then we can either select J or K. J or K. But the investors, they are not going to invest their entire amounts in a one particular security. Rather than doing that one, they are tending to connect the two securities, three securities, four securities, and do the portfolio investment, combining the securities. They are not like to take the entire risk and return. By sometime even the return is high now, in the future there might be a high risk. There might be some losses. So therefore, what they are doing is they are taking the portfolios, or else they are combining these securities. The next task is identifying the portfolio risk and return. Here what we have calculated, single securities risk and return. Next task, calculation of risk and return of the portfolios. That means once you combine the investment in two securities, how you can take the risk and return of that portfolio. That's our next task. Okay. So then we'll do that next task in the next week. So I hope up to now the clear what you have calculated as a covariance, coefficient of variation, and then the risk, standard deviation, variance, and then the average return, and all the things are clear to you all. Any question up to now? Now, some of your members or the students are not here. They also can, when they are coming to the next week, they also can have the idea regarding how we can calculate the risk and return of the individual securities. So because we did it in very slowly, as you all can understand. So therefore, I hope when please inform the other students also if they are not at the today's lecture. When they are coming to the next week, please refer the things and come. Otherwise, when we are combining two securities, it might be sometime difficult to understand the concept if you don't have proper understanding regarding the basics. Okay, that's why I did the basics in very smoothly and very slowly, as you all can understand. All right, so then we'll mark your attendance. Any questions? Okay, we'll mark your attendance. Give me 1 second. Most of the students, your students are the race course, rugby practices, not practices, rugby matches. I met them and then they asked me to don't give the quiz today. So therefore, based on that request, since some of the students are playing there, I didn't give you the quiz. But next week, definitely we have the quiz. Huh? So therefore, ready for that quiz. Can I just have something? The students who provide me the answers, are they online students? Or is the class, they are participating for the physical lectures? Yes?
I'm participating in physical lectures, ma'am.
Okay.
I'm also participating in physical lectures, miss.
Okay. Boys?
I'm also participating physical lectures.
Any online student there? No.
I'm physical.
I'm also answer teacher. I'm online student.
Yes. I just want to clarify whether I'm just when I'm doing the lectures at physical class. So even they are ready to give the answers, I'm not taking the answers because of the time constraint. That's why I'm just asking from you whether I'm at the physical classes. Am I neglecting the answers? That's what I want to clarify. That's why I asked. Anyway,
Not
thank
only
you
me,
for
madam. Not only me. Other two online students also reply.
That means when I'm doing the lectures at physical, I have to take the answers from you as well. Ne? You all are there, and then
Yes,
you are
ma'am.
doing the activities as well. Ne? Thank you. But
Yes, ma'am.
right.
Thank you, ma'am. Thank you.
Okay. නැත්නම් මම අහන්නේ නෑනේ ඔයාලගේ ඒකයි මං ඇහුවේ. Okay. I shared the screen. Now you all can mark the attendance.